Today we're in Johannesburg, South Africa, to meet asset leasing entrepreneur Zakhe Khuzwayo. This South African entrepreneur is a co-founder and the chief financial officer of Innovent, one of South Africa's leading asset rental and management corporations. Together with co-founder DJ Kambula, the pair has pioneered the large-scale rental of refurbished technology equipment through a subsidiary called QRent. And in doing so, they've greatly extended the accessibility and financial viability of the IT equipment rental market. Innovent has grown into a multi-billion rand organization with operations across the continent, including in Zimbabwe, Zambia, Tanzania, Kenya, and Great Britain. We met Zakhe Khuzwayo at Innovent's Sandton office. Zakhe Khuzwayo, welcome to this inaugural episode of Emerging Market Leaders. Just to kick us off, give us a sense of your upbringing, your background.
Okay, so I was born in a small town called Pietermaritzburg, in a township called Edendale. My parents were both teachers. I managed to get a bursary to go to Hilton College, where I did my high schooling. I got another bursary to go to varsity.
Where you read accounting and completed a Bachelor of Commerce honours. Then you joined PricewaterhouseCoopers as an article clerk, spending 3 years there, qualifying as a chartered accountant, after which you exited public practice and were employed at an asset leasing company in Johannesburg, where you spent 2 years, and that's where you met your current partner, DJ Kambula.
That's correct. I worked with DJ at the previous company. In fact, I used to audit that company, and he actually recruited me to join it. And then when we decided to start Innovent, DJ called me and said, listen, let's start something and let's do our own thing.
Oh, really? He recruited you?
Yes, he recruited me into the company.
And what was the basis for him recruiting you?
I don't know, maybe just found me to be a likable fellow, and we just got along.
So at age 27, you ditch corporate and you decide, together with your partner, DJ Kambule, that you're going to set up an asset rental and asset management solutions provider. How did you come to the decision to leave corporate?
Well, that decision was quite easy for me because I'd always known that I'd have my own company one day. Growing up, I was always just entrepreneurial. I used to see businessmen around my neighborhood, and that quite struck a chord with me that, this is what I'd want to do. I'd love to run my own company one day. So when Mr. Kumbula said to me, listen, let's do this thing, and I was young at the time as well, I just qualified. I always had that safety net that if it didn't work out, PwC were always going to take me back, or any other bank, or I could be a financial manager or financial director in any listed company. So it wasn't that much of a risk for me, so it was an easy decision. And
that was important, having that safety net in terms of the qualification based on your background and where you had come from.
Yes, it was important. My parents were very conservative, and I guess that was also instilled in us. They taught us, don't get into debt recklessly, you should save, don't start a family too young, and all of those things. I do take a lot of risks, more than my partner, but I always want to take a calculated risk and have some kind of insurance or fallback that can save me from complete disaster.
What you were setting up was not new in the market. There were already other established players. What did you bring to the table in terms of the differentiator?
The one major problem for clients was the fact that at the end of the lease, there was always these extra charges that came on. For instance, if you returned equipment and it was damaged, if you returned equipment late, there were extra charges and penalties and things like that. I'm sure a lot of people have experienced this in their everyday lives, where you rent a car from a rental company, you drop it off, and then only to get home and find a bill that, there was a scratch on the bonnet, the windscreen was cracked, and all of those things.
Leaves a bad taste in the mouth.
Leaves a bad taste in the mouth. And a lot of clients were complaining about this. They loved leasing because it took away the hassle of owning an asset. They didn't have to worry about the end of life of that asset, the obsolescence, especially the technology assets that tend to get obsolete quite quickly. So they loved the model, but they just didn't like the sting in the tail. The reason there's a sting in the tail is because the leasing company hasn't really made money from you in the initial term that they've leased the asset to you. So if you, for instance, lease a computer for 3 years, all that's happened in the 3 years is that the leasing company has recovered the cost of that asset. Now, in order for them to make money, they then have to come up with all these charges at the end. We then said, we need to take away the sting and the tail. There must be a secondary market for these assets. Why don't we create a model whereby we are able to make our money from a secondary market? So when the asset comes back, don't just simply auction it off or sell it off, fire sale. Create a market where you can actually capitalize on some value in that asset so that you don't have to charge your initial client for those end-of-term charges.
And fundamentally, your most important differentiation was the transparency in terms of the contractual arrangements, and you emphasized the ethical side of the business was critical.
We wanted to create an honest business and a business that would last for many years to come. And we knew that the current model was just not sustainable because a lot of clients would do leasing once and after that they'd go back to owning equipment because of just these surprises at the end. We had to create a model that worked well for us. We also make money and worked well for the client as well because it was cost effective for the client.
It wasn't an easy start, was it? The two of you shared a desk with one telephone. You struggled to raise funding for the venture with multiple rejections from the established banks. Talk us through that process of setting up the firm, raising the capital, and very, very importantly, actually getting your first client.
The business plan we did, which wasn't a problem, we were both financial, so that was easy. But we knew that in order for this business to succeed, we needed a bank. Because the business is capital intensive, you've got to go buy assets first and then lease them so you get your returns over a period of time. It's not like a trading company where you buy stock, sell it, make margin, buy stock, sell it, make margin. So we needed a bank and we had to approach the banks. Now, the banking industry is very small in this country, not small in terms of size, but just the number of banks. So initially we started talking to the big banks, but even getting to the right people at those places is impossible. And then eventually we managed to get a contact into a small bank, Sasfin Bank, where we actually met with the CEO of the bank, who listened to our story and was quite taken with the idea and what we were trying to do. And they immediately said that they were willing to fund the business.
Why do you think the mainstream banks were hesitant to fund you?
The business concept around making money post the lease is a difficult concept for a banker. Our business model was the opposite way. It said that we don't make money when we buy the asset or when we lease it out. We actually lose money up front because we subsidize the cost of that asset. And it's this subsidy that the bankers just couldn't get. How do you lend money out, not get a return from it, but hope and pray that in 3 years' time you'll find a secondary user who'll then lease this asset, and that's only then when you'll make your money. And the whole return on investment just didn't make sense to the banks.
So you interact with Sasfin, they agree to provide the funding. How do you get your first breakthrough client?
Because our business is really focused on technology assets. That's where the model works well. It doesn't work well for manufacturing assets or long-term assets. We knew that, for instance, the public sector or government needed to procure a lot of assets, and they procure a lot of technology. When we started the business, the first 6-7 months, that's what we did, and we're just not getting headway. Even if you do get to convince your potential client that this is the way to go, it must go out to tender. There's all sorts of procedures that you must go through before you can even get a deal. And we realized 6 months into the business that we weren't going to make headway. We then shifted our focus and said, listen, let's go into the private sector. Although the private sector was crowded because of the international players that were in there, we just felt that we had more of a chance of breaking it through in that sector. And we got our first deal 7 months into the business.
So instead of a client buying the asset outright using their own capital or borrowing the money from the banks, you give them the option to rent the asset with very limited capital outlay upfront, a predetermined monthly rental over the duration of the lease, and in event manage and maintain that asset at the same time.
That's 100% correct. The only thing you've left out is the residual. We invest a residual into that asset, into all our assets, because we know that there's value downstream for those assets. And with that residual invested in that asset, the client ends up paying less than the cost of that asset. And that's the key to our business.
And in addition to that, the client gets the benefit of flexibility regarding the upgrading of equipment, not being exposed to rapidly changing technology, and you've got relationships with multiple vendors. So you can match clients with the most suitable equipment and an overall give them a bespoke or customized solution. Ultimately, from an Innovent perspective, you cash in on that rental agreement. Is it almost simultaneously by discounting it with one of the financial houses, or do you to a degree hold on to some of those rental agreements on your books?
So all our rental agreements are discounted to a bank. We believe that we are good at asset risk, but we're not good at credit risk. So we let the banks take the credit risk by discounting those leases to a bank. And the only risk we take is the asset side, where we say that we know that we can find a secondary market for that asset.
And you've grown this business rapidly. You've secured a significant portfolio of listed blue chip clients, medium-sized businesses, and you've actually broken into the public sector. You've been recorded as stating, open quotation marks, "We didn't expect to get this big." What do you mean by this?
Up front, we knew that we would have a division that would capitalize on the secondary market, and that was QRent. But what we didn't realize was that the QRent would have such a demand in the secondary market that our initial clients in Innovent were just not procuring enough and returning enough assets for us to satisfy the demand in QRent. You know, when we started, we expected to create a business that maybe did 500 million to 1 billion, but things just tend to develop a life of their own. I would never have imagined that we would have a business in Zimbabwe, in Zambia, and Tanzania. And that's really when we then decided to actually go to London, because it was so much of a bigger market that we could get those assets from a developed economy being able to come back into South Africa and then being able to satisfy the demand in QRent.
Let me just step back and drill into the QRent business model somewhat. So you have a significant portfolio of clients who, let's say, are leasing computers, laptops, and at the end of a 3-year lease, they may want to replace them. You take the old laptops, you refurbish them, but they're largely in actually very, very good condition, and then you subsequently lease these out to other parties who are very, very happy to take on what is effectively second-hand equipment.
Correct. Your initial lease is to a big corporate. The equipment is sitting in a clean environment. So when you get it back, it's relatively well looked after. You just need to do a bit of aesthetics, maybe upgrade a few things because it's old generation components, and you then release it. So what would happen is a small company or a school or a call center, someone that didn't really need the latest and the greatest technology, was happy to get a 3-year-old brand name machine for half the cost that it would cost them to buy a new one. So it's exactly the same model that you'd find in, for instance, the vehicle space. A lot of people don't buy new cars. For instance, myself personally, for a long time, I never bought a new car because it was just expensive and it just wasn't worth the price that you were paying. You can get a demo model with, say, 30, 40,000 kilometers in the clock, pay half the price of a new one, and you still have the maintenance plan and all of those good things.
And the same performance.
And the same performance. So why pay the price of a new car?
And critical to that in the IT equipment secondary market is segmenting your users. Most users don't use 80 to 90% of the capacity, yet companies are paying for 100% of the capacity.
Your mainstream user can quite easily use a 3-year-old refurbished machine and pay half the price of a new one, saving costs thereby, but still have the performance and all the good things that they would get from a new one.
And that's key, the economics, effectively a 50% saving.
Exactly.
And it scales up the more computers there are in your larger corporates.
And that's where, you know, we found our breakthrough as well, because we thought, okay, we'll take our second-hand equipment into SMEs, into smaller businesses, into schools. But we actually realized that it was the big corporate that was taking the large numbers, because you take a big corporate, an insurance company that's got 6,000, 8,000 people, and say to them, cut the cost by half of these 8,000 people procuring computers, you start to see the scale of the saving.
And the key part of that is changing the mindset of a refurbished versus a brand new computer.
There's definitely a mental barrier there because we tend to associate refurbished with being second-hand and it's falling apart and that type of thing. If we came and sold you a refurbished device, that could be the last time you see us. But because we lease it to you, you're actually in the driving seat, because if the equipment's not working, you simply don't pay your lease. You're not at risk because I'm leasing it to you, I'm not selling it to you. Therefore, if it doesn't work, you simply don't pay for that equipment. And it comes with the warranty, it comes with the maintenance and all of those good things. So you're getting exactly the same support that you'd get for a new device with the refurbished device at half the cost. It's a no-brainer.
Are you using a refurbished computer?
Absolutely. The whole organization uses refurbished devices.
The whole of Innovent and QRent, they all use refurbished devices.
We stand behind our product and we believe in our product.
Part of the long-term goal, as stated by your partner DJ, open quotation marks, every financial director and chief information officer should not sign off on anything until they've seen the QRent alternative, close quotation marks.
It is a bit of a cheeky statement to make, but that's how we've built the business. We've gone to corporates where a lot of people would just give them a wide berth and say, why would someone like a Discovery Health listen to me? Why would a PwC listen to me and take a refurbished device? But those big corporates actually listened to us and they gave us that chance, and now they're using refurbished devices and are saving millions, hundreds of millions.
You opened up offices in Harare, Zimbabwe, in Lusaka in Zambia, in Dar es Salaam in Tanzania, in Nairobi in Kenya. What is your thinking expanding into these frontier markets?
Well, the thinking there was that because our model was based on the fact that we would make money in the secondary market, we had to ensure that we had a big enough secondary market. We then expanded into these countries in order to make sure that whatever devices came out of South Africa would have a home in these secondary markets.
You also don't seem to have opened up offices in relatively affluent and stable but small African countries. I look at Namibia, Botswana, that are right at your doorstep. Why is that?
Those markets just didn't have the numbers. They just didn't have the people. The organizations were small, and it would just never be able to consume the numbers that were coming out of South Africa.
It's a volumes game.
It's a volumes game, correct, yeah.
How are you funding your activities in these particular markets? For instance, in Zimbabwe and Tanzania, where capital markets and the banking system are very, very different.
Funny enough, these markets actually presented an opportunity for us because of the lack of financial services and access to capital. We were able to bring a product into the market that theoretically didn't need to be funded.
There's no liability.
There's no liability against it. So we're able to create a funding model for someone who couldn't, for instance, go to a bank and borrow money to fund an asset, and our model suited the market quite well.
How have those markets performed?
The markets have performed fantastically well. In fact, funny enough, Zimbabwe is our best performing market. The parents just prioritize spending on education. And with the model that we came with, where schools didn't now have to go and buy new equipment, but could lease equipment over 3 years, they could literally equip their schools quite cost effectively for less than $1 a child per month by adopting our model. Zambia is doing very well as well. Tanzania is still performing below our expectations, but it's a big market, and it's one of our youngest investments, and we think that it will improve over time.
Notably, you haven't established a presence in West Africa, countries like Ghana, Nigeria. Why is that?
Well, we sort of took a route where we said, let's follow the English-speaking countries because it's just easier to do business there. We then said, let's look at East Africa first, just because of the ease of doing business in those places, closer proximity, and the model suited. We could speak to banks there, etc., etc. From there, our next foray will be into West Africa. We're looking at Nigeria, possibly Ghana as well. So it's part of the plan.
You mentioned establishing the UK office. You're two relatively young African boys with respect. What was your experience in terms of setting up that operation?
It was difficult setting up in the UK and quite expensive, I must say. That's probably one of the lessons we learned. It's very, very expensive to set up businesses in these developed countries.
Well, in terms of the infrastructure, just the office, the employees, the network, is that the cost?
Yeah, the overheads are high. You know, the salaries in the UK are astronomical. And you've got the exchange rate problem. So you're funding a business in pounds, but you're using rands. But the market is just so much bigger. It's just so much bigger.
How did you convince potential customers and clients in the UK?
Okay, so there were two things. Once again, the sting and the tail. The markets in the UK were used to having the sting and the tail as well, but no one had come up with a viable model. The whole concept of having to refurbish and recycle equipment resonated with a UK customer because of the good, the good
Sustainability. Imperative, CSR.
Exactly, they were actually doing a good thing, and we were able to convince them that, listen, your computer that you'd normally just throw away here is actually going to end up in a school, in a small business, somewhere in Africa. And that gave them a feel-good effect to say, okay, we're not just throwing stuff away, but it's actually going to be useful down the line, and this is actually quite a good model.
When you set up Innovent, right from the very beginning, 4% of the shares were owned by a foundation. What was the discussion you had as the co-founders in establishing that foundation up front?
Both myself and DJ have been recipients of goodwill. We felt that we needed to do the same and pay it forward in a way, and actually have it established as part of the structure and the DNA of the company. What we thought we'd struggle with was convincing a funder. Funny enough, they were actually quite impressed with the idea, and they actually liked it as well, and they agreed to fund this whole thing.
Foundational to Innovent is the partnership between the two founders, yourself and DJ Kabula. How would you define your relationship?
We're totally different people. DJ is more intense. He's more of a speaker. He's more of a leader, whereas I'm more I like to work in the background. I enjoy crunching the numbers, and I'm actually a man of few words. And I guess just honesty between the partners. I think that's been the most important thing in our relationship for the past 13 years, is that we're completely honest with each other, and we disagree a lot of the times, but in the end, it's all done respectfully. At the end, we come to a consensus, and most things are consensus. Yeah.
Speaking to your colleagues, some of the comments they made is they respect each other immensely. It's like a marriage, better than a marriage. Some people say that Zakhe runs the operations of the company. He's the efficiency, value for money, execution guy, and he doesn't throw money at things. Whereas DJ is the sales guy, the vision, the drive, instilling the passion amongst the staff. And building on this interaction between yourself and DJ, tell me the story of how the name Current was adopted.
Yeah, so DJ had come up with the name Computer Hire. I heard this name, I was like, okay, it's fine, but I wasn't quite convinced that it was the right name. On my way home, I stopped at a bar, and it just came to me that we needed to have a name that assured clients that this was quality equipment, and we had actually the quantity of equipment that we portrayed we had. But at the same time, we still had to have the rent name in the name of the organization. So I then said to him, why don't you call this thing Current?
So urban legend has it that you sent out the email, or was it a text message, at 11 o'clock in the evening, and the decision was made and it was accepted right away.
It probably wasn't as late as 11. I normally wouldn't stay that long in a bar, but in fact, I think we had a call. And I said, listen, this name is not going to fly. We need to use Current. And DJ being DJ, he tends to trust my instinct, and he agreed, and that was the name, and everything had to change now because we designed the name and the logos and everything, and at the 11th hour, they had to scramble around and find a logo for Current, and that's been the name that has stuck around.
How has your leadership style evolved or changed in the 13 years since you set up this business?
I've always been really a stickler for accuracy and detail and getting things right the first time. And I just couldn't understand why someone doesn't check their work 2-3 times, etc. But over time, I've learned that you've got to be more accommodating of people and allow them to make mistakes as long as they don't cost you a hell of a lot and they learn from them.
Up till recently, you had a policy in the firm that if someone left, they'd made up their mind that Innovent wasn't good enough for them and therefore they couldn't come back. You recently reversed that stance. Why is that? And what does that say about how you're leading today as opposed to how you were leading 5-10 years ago?
Yeah, I suppose it points to maturity as well in the leadership style. We used to have a saying with DJ, that this organization does not negotiate with terrorists, because I guess we were just passionate about the business, and we just couldn't understand why someone would want to leave.
Terrorists being people who exit.
Of course, yes. And I guess we took it personally when someone left, because we thought we were creating this thing and we had a vision and we shared this vision with them. And we've got an open door policy. If we've got this open door policy, why are people deciding to rather leave than actually come and talk to us? And we just felt that, fine, if you've made your decision to leave, then don't come back.
So why has that changed now?
The organization has grown. Back then when we started, we were probably 3, 4, 5, 6 people, maybe grew to 20, 30. But when you start growing into the hundreds, you start feeling less, I guess,
insecure.
You understand that people move on. They probably think the grass is green on the other side and they come back. And it just becomes impossible to close the door on everyone whom we felt that, listen, it would actually be cutting our noses to spite our faces if we didn't let them come back.
You attract a great deal of personal loyalty that has subsequently been passed on to the Innovent brand. What do you think it is in your leadership style that could possibly explain this?
I don't know, we care about our people. And that's probably one of the things as well, that we get so upset when someone leaves. We go beyond what we need to do. And we don't tie people to working for the company. I'm glad that people recognize this. They actually, I suppose, appreciate it, what we actually do for them.
So what are your goals and ambitions for this company? If we had to look over the next 5 years, 10 years, 15 years, and do you have an end game?
So our goals for this company is really to just grow it, create a legacy. It doesn't necessarily have to be a massive company, but it needs to be a meaningful company that creates opportunities for people and creates wealth for the people within the company and the shareholders. To have it become a symbol of excellence out of the continent.
A flagship.
A flagship out of Africa, yeah.
And having said that, what advice would you give to aspiring entrepreneurs now?
If you want to do business, start it early. Go out there and do it. Don't hesitate. 80% of it is luck. And I believe that luck is there for everyone. There's no such thing as being unlucky. And try and do something that you actually know and understand, and then focus on it.
Stick to 1 or 2 things, as you've said previously.
Yeah, stick to 1 or 2 things that you understand and can focus on. Don't spread yourself too thinly and do everything that comes along, be it BE deals, be it mining, you're in telecoms, you're in healthcare. It's just, big organizations like Bidvest or someone can do that. They can diversify because they've got the infrastructure and the resources and the money.
And the DNA.
And the DNA which they've created. But if you're a one-man show and you're just starting out, don't do too many things. Focus.
Looking back on the past 13 years plus in terms of your career, what's the biggest mistake you've made?
Bad hiring is one of the costliest mistakes you can ever make in an organization, because it ties you down for a long time. It's a lost opportunity. And the process of getting rid of a bad hire is just so painful. and they tend to make it as painful as possible for you to get rid of them.
And of what are you most proud?
I'm proud that we've created an organization that really symbolizes excellence. I think if you walk through the corridors of this company, you get that feeling that people are not just here to work. They spend long hours. They come in on weekends. Nobody tells them to, and they just do it because they love doing it and they love being here. And that I'm proud of, is creating a company where people are proud to work in.
Zakhe Khuzwayo, it's been a pleasure. Thank you very much.
No, thank you, David. It's been good chatting to you.